Tom Lee has recently claimed that the real bull market hasn't even started yet. He is now predicting that the stock market will more than double in the next 5 years thanks to, you guessed it, artificial intelligence, AI. According to him, if you're not buying stocks right now, you're going to miss the biggest rally of your life. Now listen, if you're a regular EM viewer, first of all, thanks very much for watching. Second, you know this already sounds like the exact opposite of what we've been talking about in our Warren Buffett videos. Buffett is sitting on almost $350 billion in cash right now, and people are worried about a looming stock market crash. But then here comes Tom Lee saying, nope, pile in, time to buy, don't miss out on the next boom. So, who's right? Is this the next roaring bull market? Or is this a temporary new high before the crash? In this video, we are going to break it all down. What if the crash never comes in 2026 or even in the next 5 years? What if this AI bubble doesn't pop? And what actually has to happen for the market to double in the 5 years fundamentally, not just on price movement? And hey, if you're new here, welcome to the only YouTube channel that teaches investing like it's supposed to be taught, with logic and discipline. You're about to hear things that no one else tells you on YouTube. All right, so let's talk about Tom Lee and what he's out here predicting. According to him, the S&P 500 is headed to 7,000 by the end of 2025. And guess what? He looks right. It just keeps on trucking up. It's currently at 6,904. But then he goes further. He thinks it'll blast off to over 15,000 by 2030. Here's exactly what he's saying. First off, corporate profits are booming. Lee believes that we're entering a period where companies are going to earn record profit for years to come. Some might call it a permanent plateau. Think about that. He's not talking about recovery. He's saying business is already strong and it's about to get stronger. Fat margins, high demand, more productivity, all of it feeding into the bottom line. Second, consumer balance sheets are still strong. Despite inflation, despite rate hikes, he thinks the average American still has cash, credit, and confidence. He's ignoring the fact that we're at record highs of consumer debt. We have defaults on credit cards and car loans at 10-year highs. Forget about that stuff. Forget about the actual facts. What fuels spending is what he mentioned, and spending keeps on growing. No slowdown, no recession, just good vibes and economic tailwinds. Third, the Fed's going to cut rates. Lee sees interest rates dropping, not rising. And to him, that's rocket fuel. Why? Because lower rates mean cheaper debt, higher valuations, and more investor appetite for stocks. He thinks the worst of the Fed tightening cycle is behind us. Now, here's the big one, artificial intelligence. This is the crown jewel of his thesis. According to Lee, AI isn't just a cool tech trend. He believes it's the start of a new industrial revolution, one that's going to boost productivity, create massive demand for hardware and software, and completely change the global labor market. He even claims that AI will help solve the global worker shortage. Lee says that AI and tech are going to become half of the S&P 500. Right now, tech is already at all-time high chunks of the index. But if he's right, it's going to dominate even more. And guys, the move from 35 to 50% is a massive move. This means that more money flowing into names like NVIDIA, Microsoft, and all the AI winners. And when tech leads, the market follows. Lee points to history as the 1950s and the 1980s as examples of demographic waves that have driven markets higher. Now, when you add all this up, his advice is pretty basic. Buy the S&P 500. Buy VOO, buy SPY, ride the wave, maybe throw in some small caps, some financials, and Bitcoin. And his message is simple. Get in now or miss the train forever. Now here's the wild part. Tom Lee is not the only bull in this parade. He's not out there by himself claiming the stocks will go higher. No, this is becoming the consensus. Wall Street analysts, big banks, media outlets, they're all lining up behind this exact same story. When someone says the market's going to double in 5 years, you better ask one simple question. What has to happen to make that real? If I looked at you and said, your income's going to double in 5 years, would you say, that's sweet? You'd probably first go, all right, but how? Well, why wouldn't we ask out of the market? And that's what we're really going to do in a couple of minutes, because I'm not here to root for or against Tom Lee. I'm here to look at the numbers and to history. And I'm going to walk you through exactly what would have to happen for this prediction to actually come true from a valuation and fundamentals case. But before we go there, let's talk about some of the other claims that Wall Street's making. Now, let's talk about the big, bold prediction being thrown around right now about the S&P 500. Because Jim Cramer, yes, that Jim Cramer isn't just cautiously optimistic. He is saying that the bulls have the upper hand, that betting against this market is a loser's game. He believes that the S&P 500 still has plenty of room to run. And if you sit out, you're going to be left behind. So what's his case? Well, Cramer's argument starts with this idea. The storm is over. All the scary headlines, Fed tightening, inflation, shutdowns, geopolitical noise, they're old news. According to him, the market's already absorbed those punches and is still standing. And that is strength to him. And guess what? I don't blame him. Those were really big issues we dealt with. And the market just kept trucking on higher. He is saying that the S&P has proven it can handle the hits. And now, as interest rates ease and corporate earnings hold up better than expected, this index could quietly climb higher than most people think. He isn't giving a hard number like Tom Lee's 15,000 by 2030. But the implication is very clear. Don't fight the bulls. Cramer sees strong fundamentals coming from sectors like tech, energy, and infrastructure. He believes AI isn't hype, that it's an economic force that will keep margins high and productivity growing. And as that plays out over the next 5 years, he's basically saying that the S&P is nowhere near done. Is he calling for that double? Not directly, but when you listen closely, it's all in the tone. He is siding with the same crowd that Tom Lee is in. People who believe we're in the early innings of a multi-year bull market that could take the S&P 500 to levels most investors think are impossible. And speaking of impossible, let's talk about my girlfriend, Cathie Wood. Because when it comes to long-term predictions, she doesn't hold back, and she is the biggest dreamer of all dreamers. While she's mostly known for her moonshot calls on Tesla and disruptive tech, she's also dropped some broad market takes that echo the same themes. If AI, automation, and innovation take hold the way she expects, the entire market could see a massive re-rating. Analysts at ARK Invest, if you want to call them analysts, I like to call them dreamers, see the potential for the S&P 500 to hit 15,000 to 20,000 by 2030, which would add trillions to the global economy. Their bullish outlook is based on a massive boom in artificial intelligence, robotics, and other technologies. So, when you put all of this together, here's what you got. Tom Lee, 15,000 by 2030. Jim Cramer, bull case is winning. Cathie Wood, we're heading into a tech-driven explosion that could go higher than even Tom Lee's prediction. And all of three of them are pointing to the same conclusion. The S&P 500 isn't expensive, it's early. This all sounds exciting. Now, let's take these bull cases seriously for a second and ask, what actually has to happen for the S&P 500 to double and hit 15,000? Because if you're going to buy right now at these sky-high valuations, you better have a damn good reason. And that's exactly what we're going to dig into right now. Before I go further, it's very, very important we understand something. We don't know where the market is going. Making predictions about prices is impossible. What we do know is we have 150 years of stock market history. And yes, the stock market was different 100 years ago than it is today. But what's not different is money. If you had $1 million in 1920 versus today, yes, it was worth a lot more money in 1920 than it is today, but a 10% return in 1920 was still a 10% return today. And whenever you're investing, you're trying to figure out what's a reasonable rate of return on my money. Why would that change over time? So you might be wondering, well, Paul, if you're saying that you can't say that stocks are going to go down, yes, I can. I can say they're expensive and eventually they'll come down. What I can't say is when. What I can say is I'm going to look at history and say, man, the next 5 years for the market to double, what can't happen? Well, I'll tell you what can't happen. We can't have any sort of bad news. We can't have anything but massive growth in earnings and GDP. These things have to happen for that to happen. Why? Because the U.S. economy holds these companies, the S&P 500. And these companies, S&P 500, it makes sense. If the U.S. economy doubled, how should these companies do? They probably double with it. If you look at it as just tickers going up and down, I can't help you. But if what I just said makes sense, then I think you're going to get a lot out of this video. So right now, the S&P 500 is selling for, let's just round it up to 7,000. And if the S&P 500 was a share, it would make about $220 per share. So right now it's selling for, do that math, about 34 times earnings. That's high. Historically, the market sells for around 16 or so multiple. So if the S&P earns 220, multiply it by 16, what is that? 32, 320, 3,500. based on that. Okay, reasonable. Now, my stock market GDP ratio says that fair value is around 3,000. My 10-year PE ratio, which takes the last 10 years of earnings, brings it to today, that says about also 3,000. So the bottom line is, it's saying that we're probably overpriced sitting at $7,000 in the S&P right now. If you can grant me that and say, Paul, these are the facts. This is history. This is what it shows, what history shows. Doesn't mean that that should be the future. I get that the economies now are different. I've even said that companies these days don't need to build factories and spend millions of dollars to make money. So there should be a premium paid to the entire market because it is easier to make money. I'll grant that. The question is how much of a premium. So let's say that premium, instead of 16 times, is 20x. So now if the market makes 220, it's worth about 4,400, 20 times earnings. Makes 220, multiplied by 20, boom, 4,400. Great. For the economy to make for the S&P to be at 15,000 in 5 years, divide that by 20. It needs to make $750 basically per S&P share. We're currently at 220. That means it needs to go up about 3.4x in the next 5 years. Okay. So 3.4x over the next 5 years. Guys, it's simple math. 3.4 to the power of 1 divided by 5 minus 1. This will be the growth rate that's needed. The S&P needs to increase its earnings by 27.7% per year for the next 5 years. Now, let's do the math here. Let's understand this. Now, if you're not somebody who's ever looked at the history of growth and history of anything, this is a tough pill to swallow. Guys, let's look at it this way. Let's go back to history. And let's say that that just means that the economy needs to grow at 27.7% per year. That's essentially what it means. Guys, this is the GDP every single quarter going back to 1950. Because they talk about 1950s and 1980s that were in the early stages of it. This is the 15-year growth rate of every single quarter starting at 1965. Look at these numbers: 6.3, 6%, 5%, 7%, 8%, 9%. Okay, it's getting up there. Economy is growing faster. Then it starts to slow. Then it starts to slow. Then it starts to slow. This is the 15-year growth rate. As time goes on, it is growing at a slower and slower clip. So I look at this saying, is it easier to grow when the economy is small and has a lot of potential, which AI could uncover? But guess what? In the time period from 1950 until now, computers, going to the moon, internet, AI, all these things happened. And yet we didn't see massive growth rates. This is the same thing that was said back in 2000. The internet is changing business forever. It's going to make businesses so much better. It did. But look at the growth rate. From 2000 until now, until 2015 would be the 15-year rate. 3.9% per year. That was the GDP growth rate back for the 15 years following 2000. Guys, AI will change the world, but we're not going to get 27.7% growth to justify the S&P being at 15,000. How would it have to happen apart from that? Well, we'd have to see massive GDP growth that is basically not justified. Well, how do we do that? Guys, I hate to tell you, inflation. Because in order for GDP to grow enough to justify the US economy growing 2.8 times or 3.8 or 3.4 times, you need to inflate the hell out of money. Well, when there's inflation, what does the Fed do? They increase rates. What was Tom Lee's argument? What was Jim Cramer's argument? Rates were going to stay low. Because to get 28% growth a year, you basically need to grow the GDP by 28% a year. You're not doing that organically. You have to do that through inflation, printing lots of dollars. Hypothetically, let's all of a sudden increase the money supply by 5x and give it to everybody. What would happen to GDP? It'd go 5x up. Guys, I get it. I have the rep of being a guy that's a perma bear. I want to remind everybody of some things. I buy ETFs every single month in, month out. I own 28 companies. If I were this perma bear who was always negative in the economy, I would never do that. What I am is I respond to valuation, and valuations are insane right now. When the data changes, I change. The data is not telling me that this is going to happen. Is it possible? Sure. But do you want to deal with a world in which inflation is that high? Increasing rates, it stopped that so fast because guess what's going to happen? Guys, when we had 10% inflation recently, people were going to freaking riot the streets. And in that time, what's going to have to happen? No black swan events. No bad things happen. So basically what Jim Cramer, Cathie Wood, and Tom Lee are saying is, it's different this time. Let me go one more step further on the whole 1950s and 1980s analogy, because if you remember from those standpoint, markets did go up a lot of that, but let me show you why. Now, guys, this is my stock market GDP ratio. And the reference made by those guys was that we're in the early 50s and early 80s when it comes to economic growth and when it comes to the stock market growth. That's possible. But remember one thing. In the early 80s, we were coming off really high inflation. Sound familiar? We were coming off really high interest rates, 15% or more. And more importantly, the 1970s were a stagflation environment. The stock market went nowhere from 1966 to 1982 because markets were overvalued. In 1950, we were coming off of a Great Depression that went into a world war that got us out of it. For the first time, the 1950s saw a market higher than the Great Depression peak of 1928. So that's where we're. Let me show you valuation-wise. This is my chart on the S&P. The average over the last 100 years is that every 10 years, we make 6.4% per year, not including dividends. In 1950, the stock market was 35% undervalued. And guess what? For the next 10 years, it made 12.5% per year, not including dividends. I'd love to get that again. Absolutely. But that's one of their examples. Okay. Let's go to 1980. We were 58% undervalued. The market did 11.4% per year for the next 10 years. 12.2, 12.7, 13.6. The bottom of the market was right here. We saw 14% growth in the stock market for the next 10 years, not including dividends. Remember, we were 64, 65, 66% undervalued. Let's look at today. We are 126% overvalued. Do you understand why the market and the economy catapulted in the early 1950s and 1980s? Because they were starting at lower valuations. We were coming off of bad times. That's how you get explosive growth. If everything's going well right now, that's not what happens. It doesn't happen where something goes really well for a long time and it gets even better. But in order for the market to double in the next 5 years, we would need to see massive inflation, like literally South America type inflation, without the Fed standing in. Is that really going to happen? Guys, if you're new to this channel and you're new to investing, but just want to understand things, I hope this makes sense to you. I'm trying to keep it basic. The bottom line is this. The idea of getting to a certain level, coming off an amazing economy, is not what happened in the past. The early 1950s are not what we have today. The early 1980s are not what we have today. They were coming off the tail end of bad economies. We're coming off the tail end of a really good economy. Could they be right? Yeah, they could. They absolutely could, because back in 2020, I would have never thought that from the COVID lows, we'd be sitting at a point now this much higher. But anybody who believes that the market is not overvalued right now knows something about the future that I don't understand. Guys, I don't even know any country in the past that's grown 28% a year over 5 years. That's a really difficult task to do. China, which is considering a massively growing economy, they grow 8 to 10% a year. Guys, this is why I teach on YouTube, because I want to sit there and say, guys, there has to be an explanation for things. But unfortunately, with investing, a lot of people don't do that. If you made it this far in the video, you probably are one of the people who wants to understand things. Most people just want to see a ticker go up and go, "Ooh, I'm going to attach myself to that." I want to sit there and say, wait a second, this stock is going down, but the fundamentals are getting better. That's what I want to buy. Jeff Bezos talks about this. When he saw his stock fall 96% from 2000 to 2002, but all of his internal metrics were showing how much better the company was getting, that's when he realized there's a disconnect between price and fundamentals. Price and value. That's what we're trying to teach here on this channel. I would love for this to happen and be in the market. But in order for it to happen, you would not love what has to happen for that to be the case. What I want you to remember is that when things are bad, I will be the one person sitting there saying, guys, everything will be great. And we're going to get to a point at some point in the future when I say stocks are a great buy overall based on history. People will say, but the stocks keep going down. You keep getting it wrong. Well, just like stocks keep going up. Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. Picking individual stocks is real investing. Speculation is looking at a ticker and saying up and down, it's going up and down. Your job, though, is to know the difference between investing and speculation. That means understanding price versus value. 99% of people out there don't understand that. Price is what you pay, value is what you get. Let me tell you what keeps me sane when the market goes wild. Principles. That's it. Principles are what keep me from getting sucked into the noise. I'm not chasing hype, but I'm also optimistic enough to know that the US economy will likely get better years and years down the road, and even tomorrow. I'm literally one of the biggest bulls out there and so pro-America. I'm not glued to a television watching price fluctuations. I'm focused on one thing. knowing that the US economy is going to be bigger and that companies within it will also be bigger, but more importantly, taking that information, understanding the difference between price and value. When price goes up and down, like a yo-yo, most people react emotionally. They buy high because they have fear of missing out. They have that FOMO. They sell low because they're afraid of losing everything. That isn't investing, guys. That's panic with a brokerage account. These principles that I live by stop that. They give me a framework. They give me a logic-based approach that says, hey, I know what this business is worth. And unless the fundamentals change, I ain't moving. At Everything Money, and the people in Everything Money, we live by 5 core tenets. First off, we are investors. We aren't speculators. Second, every investment is the present value of all the future cash flow it receives. So we lay out money, and our returns will be based on all the cash we'll receive. The more cash flow we get, the higher return. The lower return. 3, if we don't understand it, we don't invest in it. 4, in the short run, the market's a voting machine. In the long run, it's a weighing machine. And 5th, and probably the most important, a great story, like the US economy, can still be a bad investment if you pay the wrong price. This is the playbook. It's not sexy, but it works. What's sexier to me is being able to sleep at night when everybody else is losing their mind. Now look, I'm not expecting you to memorize all of those tenets on day one. That's why I built something for you, a simple, free PDF that lays all of this out in plain English. The exact principles I use to avoid emotional mistakes and stay disciplined, even when the world feels like it's on fire. So here's what I want you to do. I want you to click the link in the description below. I want you to download the PDF. I want you to keep it on your phone. Keep it next to your computer. When things get noisy, pull it out. Remind yourself why you're here. To invest with logic, not emotion. In fact, do what I do. I just read it every day, just to remind myself. This little document could save you tens of thousands, maybe even hundreds of thousands of dollars in mistakes over your lifetime. So don't wait. Grab it, read it, and use it. Now, we just walked through the boldest predictions out there. Tom Lee, 15,000 S&P, Cramer betting big on the bulls, Cathie Wood seeing even a higher price than Tom Lee. And look, they could be right. But if they're right, it's not because of the right foundation, the right process. Maybe this is the start of a next massive bull run. History shows that's not the case. But as disciplined investors, we don't invest in maybes. We invest in what we see and what's likely to happen in the future. If the market keeps running, great. We've got a plan. We dollar cost average. We buy good companies at good prices. But if it doesn't, if it crashes, if reality kicks in, you still win. Why? Because you're not chasing. You're not guessing. You're using logic, not emotion. You're buying better assets at better prices. And as it gets lower, you buy even more. That's what separates investors from speculators. Stick to your principles. Focus on price versus value. And remember, hype makes headlines, but discipline builds wealth. All right, guys, if you made it this far, that tells me one thing. You're not just here for hype. You're here to learn how to win when it actually counts. But I want you to listen closely. What if Tom Lee's wrong? What if the bulls are way off and this isn't the beginning of a melt-up? That it's a setup for a breakdown? Because if this AI-fueled rate cut, everything goes up, fantasy doesn't play out, guess what happens? Prices fall. And they're not going to fall just a little bit. They're going to fall hard and fast. And when that happens, you have a choice. Be prepared or be crushed. In this next video, I'm showing you exactly how disciplined investors, people who ignore the noise and follow the numbers, can actually build life-changing wealth during a crash. So click the video on your screen right now. Let's make sure you're ready. Thank you for your time.